Welcome to the Investor Fuel Real Estate Investing Show, where I interview the nation's top real estate entrepreneurs, industry leaders, and other amazing entrepreneurs to help educate and inspire you to take your business and your life to the next level. My goal is to add tremendous value to you during every single episode of this show. If you get value, I'd love it if you subscribe on your favorite podcast player, subscribe on YouTube, and my very favorite, please share this with your community so we can impact even more entrepreneurs. Let's start today's show. Hey, everybody, welcome back to the show. Really excited to have my buddy Michael Velasco here. Today, we're going to be talking about everything you need to know about 1031 exchanges. There's a lot of misnomers, a lot of confusion. I think at the end of the day, as a real estate investor, I know historically, somebody said something to me at one time about how much time we spend driving the top line, and we don't spend anywhere close to as much time protecting our profits. Like, we're so top line driven at the end of the day, the top line doesn't even matter. And so you've really got to be, it's really not what you make, it's what you keep, as they say, right? So we're going to be talking about how to build wealth and clear some confusion up on 1031 exchanges with Michael. So Michael, welcome to the show.
Thanks for having me, Mike. It's great to be a part of Investor Fuel and on your podcast. I really enjoy doing these.
Yeah, I appreciate that. You're an amazing resource, and it's funny. Like, for me, I used to be like the young guy in the room. Now I'm getting a little bit older. People are referring to me like the guy with all the wisdom and stuff, and got all the gray hairs to prove it. So, but I think way more today about tax strategies and stuff like that than I did early on when I was just trying to make it happen, right? And that's probably a common thing. I would imagine.
That is a common thing as we get older, like, and I just turned 50. It's like the stuff that I wish I would have known in my 20s, and the people that have been in the business long enough, they don't, you're not even in your 20s, you're not even thinking about 1031 exchange, but you get to our age and all of a sudden it becomes a very, very important topic. So,
yeah. Because you realize, some of it is you're later in life and you're starting to plan your life. Some of it also is just, you realize, like, even this season right now, like, I know, as we speak, I think right now my wife is meeting with our tax advisors and they're telling us how big of a check we have to write. And those are painful conversations, right? You have those enough times and you're like, somebody show me a better way. And we're like, Michael's going to show us a better way today.
Yeah, exactly. And it's this time of year. We're filming this in November, and it's tax planning season, right? You really gotta get to work on not only closing out this year, but into next year. And I was talking with my lead outside counsel last week, and I said, "Oh, you guys are slowing down a little bit because you're past, the extension season." He goes, "No," he goes, "This is the busiest time of the year. Everybody's trying to get all their planning done." And he's a very sophisticated tax attorney, but the wealthier you get, the more accumulation you have, the more, to your point, Mike, you want to protect it as much as you can.
Yeah, you didn't work this hard to give it all away to
exactly
other stuff. So we won't get into the political side of it. But hey, before we jump into this, tell us your background. I know you weren't always in the 1031 exchange space, but you're the absolute authority now. So tell us kind of how you got here.
Yeah, and my career really started. I was first early in my 20s, kind of in the sales role, and I got into real estate in 2004, and then ran teams, property management companies. I did flips. I did everything that a real estate investor would or a real estate agent would. And then, about 2017 or so, I said, I want to get into some different businesses. And I thought tax was a really good place to go into. So I got in with a partner who ended up buying out, and we built an accounting firm. And so I built an accounting firm, really learned the background of tax, entity structures, different types of tax returns, partnership returns, S corporation returns, personal returns, a little bit about trusts, and really, started filing hundreds and hundreds of tax returns. And, I really like being on the planning side. I like being, on the side where I was really helping business owners from a consulting standpoint. And our staff started doing 8824s, which is the rider to the tax return for the 1031. And my CPAs were turning to me going, "We're not 100% sure. We don't do a lot of these. Let's explore." So I sat down with my tax attorney at the time and I said, "Tell me everything I need to know about 1031 exchange." And so I went down this rabbit hole and I go, "Well, what's a QI? What are the ramifications of a 1031 exchange?" And so I became fascinated with it. Um, and so when I was liquidating the accounting firm, that was really the goal, to build the business and then sell it. And I said, what am I going to do now? And I loved 1031. And I started just studying as much as I could, took on a mentor, and then I opened my exchange company. Um, and and from there, I found the best. I found a tremendous mentor, and then I found the best attorney in the country that I could. And they're very tough to find, by the way, Mike. There's only about, in my opinion, 20 or so in the country that really know 1031 exchange inside and out. Because just because you go to a tax accountant or a CPA does not
Right.
mean that they're going to know about this. So there's
Yeah.
some firms that really specialize in it, and I went and found them. Matthew Rappaport's my counsel, my lead outside counsel out of Manhattan, and he's a Georgetown law alumni. Just an LLM, which is like a master's degree in taxation. And so I really, I kind of leaned on him for the better part of the beginning part of my career. Spent hundreds of thousands of dollars, getting the counsel, getting the paperwork right and everything. And then, ultimately after I was, quite a few years in the business, then I went into, I got my CES designation, which is kind of like a CPA for a QI, which is, qualified intermediary is the term. And and then really, I just started diving into more and more complex exchanges, and that's
Yep.
where now I'm today. Now I speak on panels all over the country on 1031
Right.
topics. So,
Yeah. Yeah,
so
that's
yeah,
great. And
that's a little bit
I think
about
there
it.
was a lot of people. I remember this is before I was an entrepreneur, and this was like I was still kind of in corporate America. I went to like get my taxes done at like an H&R Block type place where I just didn't know, right, at that point. I was not an entrepreneur yet. Just had a pretty simple job, And I remember they like filled out my tax returns, and there was one thing that I asked about. I was like, "Oh, what about that?" Like just something that I'd overheard. And they're like, "Oh yeah, let me check." And they put it in and like, "Oh yeah, you're going to save like another like 2 grand." I was like, "Wait, what else am I not telling
Yeah,
you to
yeah,
type in that keyboard?" That was my first realization of like, okay, all accountants are not equal. And then quite frankly, a lot of people assume that like at this point, I pay a lot for tax strategy, not
yeah,
necessarily
for
for
sure.
tax prep. A lot of the tax strategy folks, like they do tax prep, but they don't really want to. It's just part of the package. They really, what you're really paying them for is their knowledge and tax strategy, right? And then I think you get into cost segs and you get a 1031s. Like those are all specialists that your average CPA just doesn't understand to the level that you do for sure. So
Yeah,
I
for
think
sure.
just like a lot of real estate investors are, you would never just hire a contractor to like do electrical work and tile work and drywall texture. There's experts in all those things, and there are from a tax side as well, right?
Yeah, absolutely. And I think, when you're younger, you're less apt to probably spend the money on that stuff. And as you get older and wiser, you're just like, there's a reason why, they're
Yeah.
charging what they're charged because they're
What
saving
did it
so much
cost me to
money.
not do that?
Yeah,
Yeah.
exactly. And we learn
Yeah.
enough through experience where it really catches up with us, where we get older, we just go, give me the expert. And I'm willing to
Yep.
pay because I know this is an investment in my future. So,
Yeah.
and I did,
Well,
I did the same thing.
let's get into some of the basics of 1031 exchanges.
Yeah, so I think, if you're an investor watching this podcast, there's like 4 or 5 things I want you to know, and you should know about 1031 exchange. The first is that it must be an investment property. So a lot of people get confused. They think they can 1031 exchange their primary residence. And then there's so first, it must be an investment property. The second is it's any real property you can exchange into. So if I'm selling a piece of land, I can 1031 exchange it into a single family. If I'm selling a commercial property, I can go exchange it into an apartment complex. Any real property will work as long as it's real property. And there's even some like oil royalties, and there's some very
Mhm.
exotic stuff that you can get into. Um,
Sure.
the other is equal or greater value. This is the one I get probably the most calls on. Is wait a second, I just want to exchange my equity. Well, the code basically states we have to buy equal or greater value. So if you're selling $1 million worth of real estate in a 1031 exchange, you have to buy at least $1 million in real estate. Notwithstanding what the loan is on it, just remember it's equal or greater value, and all the money and proceeds from the relinquished property have to go into the replacement property.
Okay.
Otherwise, if you want to take
I
some
wasn't
out,
aware of that actually. Yeah. I thought it was more
yeah,
based on your equity. Yeah.
yeah,
Okay.
exactly, yeah, and there is something called boot in a transaction, Where let's say Mike's doing an exchange and he goes, you know what, I want a little bit of cash from this, but I don't want to compromise the whole exchange. I just want a little bit of cash. So in that scenario where we're selling $1 million property, Mike goes, hey, give me 100,000, and I'm just going to buy a $900,000 property because it's equal or greater value. I'll pay taxes just on the 100,000, and so that
Mm,
term is called boot, which is just taxable gain in an exchange where a taxpayer gets it. And Mike, you and I know in the real estate space, real estate investors are typically asset rich and not necessarily, and maybe a little bit cash poor at
right. Yeah.
times, because we always have our money working in real estate. So boot is a common thing to take, and you can't take it. So, but otherwise, equal or greater value. And then
And
the
let me ask you a
timelines.
question. Does it
Sure.
have to be, it doesn't have to be one property. Like you could sell $1 million property and buy four $250,000 properties, for example.
Exactly.
I mean, I
Yeah,
know
we're
there's some time
we're seeing
frame
that.
issues and stuff like that, but
Yeah, we're seeing that a lot in markets that this 1% rule, which we all kind of try to achieve in investing, is can we get the asset to be 1% of rent, $150,000? Like Memphis is a great example. $150,000 property rents for $1,500. Well, we have a lot of properties in California, for example, where I'm seeing this a lot. There's a $4 million property that's not renting for $40,000 a month, right?
mhm.
So they're taking their assets and they're selling them. In your case, and to your point, Mike, we're selling the one property and buying five ones that really bring the cash flow that they're looking for. So you can go down in value or up in value, sell $1 million property, buy four $250,000 properties in the same exchange. Certainly, there's a
Yep.
lot of flexibility there.
Yep. Yep.
Time frames. So this is the other thing I want the viewers to know and the investors to know. 45 days to identify the replacement property, 180 days to close it. And you're probably asking, well, wait a second, what's identification mean? So we
Mm,
close the relinquished property, and we identify, and typically your QI, and that's my role, is you have to use a QI, a qualified intermediary, to do a 1031 exchange because you cannot touch the funds. So the funds will come to an account that we insure basically with a third party bank, flows to the bank, it flows into the account for the client's name for the benefit of the client. And we just hold those funds until we're ready to close the replacement property. Okay. And so that's what a qualified intermediary does in a 1031 exchange. But back to the timelines. So if we sell the relinquished property, we have 45 days to identify. Typically, the QI will send over a form that states, hey, these are the three properties we want to identify. We'll write those out, e-sign it, and we'll keep it on file forever if the IRS comes knocking, looking for it. And that will be one of the things that they ask for is the identification form on their checklist of the audit. And so it doesn't mean you need to be under contract. Doesn't mean that you need to be, it just simply means that we're going to write them down. These are the properties that we're going to identify. And then we need to close on three of those. And there's a couple of different ways we can identify. I'm not going to get on all those today. But with three property rules, one of them, the 200% rule, is the second one if you're going down in value. But there's a couple different ways you can identify properties. And that's the thing that you want to know is that within 45 days, I've got to ID these properties, and then we have to close on them within 180 days. So
mm.
those are a little bit on the timelines.
Yeah. And what are some best practices for that? Because if you wait, I mean, I guess some best practices might be if there's obviously you got a lot of parties going on here, right? So if you're
Yes.
like, hey, I could identify a property I want to buy before I even put mine up for sale. If that seller is patient enough to like, well, wait for my timeline to fit, and they're like, hey, that's cool. I mean, that's not, having done a lot of deals myself, the seller, you do usually could care less about my timeline, right? So
Yeah,
there's
exactly.
some things you have to navigate there. What are some best practices?
Well, we've seen, and then to give you kind of a stat from last year's numbers, 2024, the average exchange in America lasted 58 days.
Okay.
So, and that was including commercial and land where you have these long inspection periods. So, typically speaking, our clients are under contract through inspection period and appraisal contingency by the time the 45 day is up. So, to your point, Mike, it's like, what is actually happening out there? Well, usually, like they're going under contract on the relinquish, and by the time even the relinquish closes, they know what they're going to buy. So I've got like 3 exchanges going on right now that won't go past 10 days. They've
Mm,
already found
that's great.
something. They know exactly what they want to do. That's not always the case, but from a practical nature, think about it. You're kind of looking and looking, while before that relinquished property ever closes. And we have 45 days, but you also have the escrow period of the relinquished property. You can begin to shop. So in practicality, it becomes less of a problem than I think people think, as long as they have a good idea
Yeah.
of what they want to buy.
Sure, it does require a little bit of planning though, right? It's just like, what do you want to happen? I think I'm sure you've been a part of this. I've seen it before where, hey, I have a client that needs like another property like right now, and because they haven't, they're probably at the end of that identification period and they haven't found anything yet, or maybe they had something and it fell out, or would that be another
Yeah.
piece of advice is to for people to have a couple different backup options in case the one that they really want falls
Yeah,
out?
exactly. And that's where we have multiple properties we can identify. And the other strategy, Mike, is that sometimes we'll be able to get the replacement property under contract with a contingency and just say, hey, in this market, it's more likely to happen, right? In
Sure.
2021, it wasn't going to happen. You're not going to accept a contingency.
Right.
And we have the tool of a reverse exchange too. We'll talk about it here in a minute. But really, sometimes you could just get it under contract and go, hey, this one's closing. You know, we're we're just gonna do a double close, or we're gonna just wait until we get this, finished. In today's market, you can get away with a little bit more when
Yep.
this interest rates go down in the next year, which is looking like what's going to happen. Then that will
Sure.
change slightly. That will change the market. But those are market
Are
driven.
are there I know you said real property, so just to kinda test the boundaries of that a little bit, are there any opportunities to sell real property and put it into any sort of REIT or other funds that are not I mean, there's real property inside of those, but it's more of a fund. Is that a realistic thing or no?
Yeah, yeah. So they have something called DSTs, which are Delaware Statutory Trusts. Not to be confused with the other DST, which is like a delayed, kind of a delayed sale trust, which I don't want to get into it very much, but they're called Delaware Statutory Trusts, which are percentages ownership of a larger commercial, typically commercial deals, and different depending on the asset class. So you can go into something like that. You can go into an oil royalty where you're just basically exchanging into royalties and just getting a royalty check off of some sort of gas or oil royalty.
Yeah.
So there's different things that you can do, and depending on what your goals are and how noisy. We talk about noisy assets all the time. Single families are traditionally more noisy. Well, at some point
Yep.
in your investing career, you don't want to deal with the noise, and then you go to a triple
Right.
net, a commercial or a DST product or an oil commodity or something like that makes sense. But it does offer some flexibility. To answer your question, Mike, you've got some great flexibility with real property.
Yeah, yeah, that's great. So
Yeah,
one more reason it makes sense to talk to somebody like you that knows what they're
yeah,
doing. So
yeah,
far we pretty much talked about I guess what you would call forward exchanges, right? Like that's you're kind of moving forward. You're going to sell something, you're going to buy something. So you
yeah.
mentioned just a moment ago reverse exchange. Like tell us more about that.
So the reverse exchange. Okay, so let's first talk about why you'd have to do a reverse exchange and the motivation why somebody would do a reverse exchange. So the IRS states that we can't own the replacement property and the relinquished property at the same time, right? So if that's the rule, then we have to come up with a way to purchase the replacement property first without it going into to your name. So let's say Mike wanted to buy a replacement property and he goes, and typically this was what happens. It hits the market and they have a portfolio of real estate. It hits the market and Mike goes, I gotta have this. It's perfect for investor fuel. It's my office that I need. It's like, or if you owned a car repair shop and there was something perfect came up for your shop, you go, hey, I gotta have it. I don't have time to sell, and the seller's not going to allow me to list my properties. Or in another case, Mike, and we get this a lot in the real estate circles, is a deal comes up, it's a wholesale deal, it's 60, 70% of market value, and they need it closed tomorrow, right? We
Right.
see that a lot too. So what the IRS gave us is Revenue Procedure 2037. So in 2000, the year 2000, they gave us safe harbor for holding a reverse exchange. And in this safe harbor, they said the QI can also act as the title holder. to the property. And so basically what we do in most states, not on all states, but most states, we'll set up an LLC in that state. So if we're in Texas, Mike, if we're in Texas buying this property, we'll set up a single member disregarded LLC in Texas. And the sole member of that LLC is going to be exchangeable. Okay. On one of my holding companies, right? So Mike's going to give me the money to buy this property. So that's the one downside of the reverse exchange is you have to have liquidity or access to a loan in order to buy the replacement property because you don't have the liquidity event from the relinquished property yet, right?
Right.
So let's just assume, Mike, you've got the capital or access to capital to buy the reverse property. So you're gonna basically extensively lend me the money, which means you're just gonna wire the funds into closing for us. And then we're going to close in this LLC, this EAT. It's an exchange accommodator title holder. We call it an EAT for short as an acronym. Just remember it's an LLC. It's an LLC with a single member as exchangeable. So now we're going to close on this property. We're going to own the reverse property. And I'm going to remember, I'm the owner, but Mike needs access to the property. So we're going to set up a property management agreement where I say Mike is the property manager on this property. So he can receive rent, he can do repairs, he can act just like a property manager, right? So for all intents and purposes, this is a legal fiction anyways, and we're just following their procedure. But Mike's really the owner. I'm just holding title temporarily. And during the interim, I'm going to give you a property management agreement. So you're going to go, once we close on it, you're going to go get it rented out. You're going to do repairs. You're going to do whatever you want to do with the property, right? And now we've started a clock backwards. We've started the 180-day clock to sell the relinquished property. Well, the 45-day still applies to identify the relinquished, but we know what the relinquished property is going to be, right? We go to our portfolio. Right. This is the one I'm going to sell. So we list the relinquished property, and then we sell the relinquished property, and now we create a liquidity event. Now that money I can give to the extent of the proceeds we have from the relinquished property. I can reimburse Mike the money he lent me to buy the replacement property. And then I go down to the Corporation Commission and I go, I'm no longer the member manager of this LLC. We have closed the relinquished property, and then on the date I transfer the membership interest over to Mike, he takes ownership, and that's the day he basically buys the property because it's after the sale of the relinquished property. And so we do a membership transfer form, and now Exchangeable is no longer the member. Mike's the new member of the single member disregarded entity, and now you're the owner of the property. And that is kind of the inner works of a reverse exchange and how they work. And they're great.
You got to definitely work with somebody that knows what they're doing. So like you, but that's got to be common because, like you said, I mean, of the hundreds and hundreds of deals that I've done, they're usually people wanted closure. That's why they sell at a deep discount. Like I want to close as fast as possible, usually. And
cash
so
now. Yeah,
that's right.
Yeah, that's why.
That's right. Yeah. That makes sense.
And so the reverse just gives you incredible flexibility. The thing that I have noticed is the longer the investors invest, the less likely they like to do forwards. They love reverse exchanges. Yeah. They will not do a forward exchange because they want to wait for the right deal as their net worth grows, their access to capital, and they're patient. The investors that are older and just they wait for the right deal, and then they like to use the reverse product, and they're a little bit more expensive. But for the investors that are saving so much, so I'll give you an example. My fees on a forward are $11.95. On a reverse, they're $84.50. So there's a little bit more expense, but remember, Mike's also receiving rent where he wouldn't on a forward. You're receiving rent on the replacement property. Yeah. So they're a great tool. Great tool.
Yeah. Yep. So how about, I know there's also something called an improvement exchange. Like, tell us about that.
Yeah. Yeah. So you may have heard of them as improvement exchanges or construction exchanges, one and the same. So when somebody refers to one or the other, they're basically exactly the same. We use the same tool. And I'll run an example, a case example. So we're selling a relinquished property in Dallas, and we're selling it for $300,000. We go out to Abilene and we find this incredible fixer-upper that's worth maybe $350,000 or $400,000 that's fixed up, but it needs a lot of work, and we can acquire that property for $200,000. And then we have $100,000 left over, right? We sold the relinquished for $300,000. We're buying for $200,000. Needs $100,000 worth of work. So in this case scenario, We take 200,000 of the 300,000 we've got from the relinquished property, and we buy the replacement property. But I can't transfer the asset to Mike until all the repairs are done for a like kind exchange. Remember, equal or greater value. So I can't transfer it until these repairs are done. So we're going to take 200. We're going to do another EAT. We're going to do another LLC, and we're going to hold the replacement property in the EAT LLC. And then I've got $100,000. We're going to hire a contractor. Mike's going to hire a contractor, and he's going to begin doing this $100,000 in work. I've got now the 200,000 has gone out of the account. I have 300,000 total, which gives me 100,000 left over. Now I can start writing that $100,000 worth of checks to the contractor that Mike picks to work, fix the house. So we have to do that all within a 180-day period. And then once the improvements are done, the exchange is now complete. Now I transfer the LLC back to Mike, but at the price of 300,000 because we did $200,000 acquisition and $100,000 in improvements. And then I basically take the title holder, do the membership transfer, and now we have a good exchange. So it is great for investors that are thinking about doing value add and using exchange funds without coming out of pocket. It's a great tool. And now we have really what, a $400,000 property, maybe 350,
Yep.
400,000 because of
Yep.
the work that we've done, market value wise. So those are just, I mean, most people don't even know the inner works of the exchange, like a regular forward exchange. But when you start getting into these exotic products and become more of a sophisticated investor, they're just fabulous tools to use, to grow
Yeah.
your portfolio and your wealth. Yeah.
Yeah, I mean, real estate is all about leverage. And I think at the end of the day, one of the things that's happening to a lot of people right now, I have a rental portfolio, family portfolio in Dallas, and they just don't cash flow as well as they used to. Like our return on
Yep.
equity is nowhere close to where it used to be because, yes, values went up on paper, we're wealthy, but the
Yes.
rents didn't go up as fast. And
Right.
also the expenses went up faster than usual too with interest or with taxes and insurance, right? And so one way to do that is to like, if you have a lot of equity in your properties, is to do a 1031 into lower level properties or other property classes or whatever that might cash flow better, or as you said, be more like a triple net lease or something that kind of makes your life easier, right? So I think,
Yeah.
I
And
think
reposition.
historically I would look at my
Yeah.
portfolios like I'm going to build this and I'm going to like keep it forever. And I just know we've had an epiphany over the past like 6 months of like, okay, this is an amazing asset. It's done a lot for us, but what it doesn't have to be the same like you can trade assets. There's things you can do that make way more sense for us based on where we are in our lives. And I think a lot of people that are listening to this, hopefully that resonates with some of them as well.
Yeah, absolutely. And it depends on what stage you are in your life, what stage you are in your net worth, your equity position, your tolerance for the noisy assets. And then, of course, repositioning. This is really what's great is we can reposition our assets without paying
Right.
taxes on it. And that's what
Yeah.
the IRS is going, okay, we'll play this game. We'll kick the can down the road,
Yeah.
which is your long-term capital gains and your depreciation recapture, which is the one thing I want to make sure our investors know. Depreciation recapture is a real tax. So just make sure it's not just long-term capital gains, it's depreciation recapture too. And there's some other taxes too that can come up too, depending on your income. But it's the ability to reposition assets without paying taxes. So you can go to a different market or you can go to a different asset class and not pay the taxes. And then ultimately, like what you're talking about, Mike, is really hitting the goals of where you are in your life, so it just depending on where your life cycle is as an
Yep.
investor. So,
Yeah. That's great. Michael, if folks
yeah.
want to learn more, they want to work with you, they want to learn more about 1031 exchanges, they're thinking about doing this, where do they go to reach out?
My website's the best place to start. It's got probably 15, 20 videos of all different types of topics. But my website, 1031exchangeable.com, 1031exchangeable.com. You can go to that website. It has all my information. The phone will come straight to me. I've got a great staff, but I take a very concierge approach with my clients. So you'll get me on the phone, which is really, I'm not going to hand you off to somebody else. They help me with the paperwork and making sure we're in compliance with all those things.
Yep.
But these are very granular. The nuances of this business are incredible. And you think on the surface, how could it be so complex? It just gets complex, just people's lives. I added a
Right.
brother. Mike and I bought a property together. Now one of us doesn't want a 1031 exchange, one does, or all kinds of crazy stuff happens in
Right.
in life. But all that to say is, you'll get it's going to be me talking with you about, hey, your exchange, what are your goals? And then, we kind of try to match you up in the right exchange and kind of go over the asset depending on the state. And then there's Mike, the other important point is there's state nuances. If you're in California, it's a little bit different rules. If you're in New York, it's a little bit tougher. So depending on the state that you're in, there could be some little nuances there. And those are in the discovery call when we talk about the exchange, those are the things that we'll talk a little bit about.
Yeah.
And so 1031exchangeable.com, you can get a hold of me there if you like.
Perfect. We'll add a link down below. So guys,
Yep.
if this sounded interesting to you, if you're thinking about how this could be a great vehicle for you, I definitely recommend you reach out to Michael. We'll put a link down below in the show notes. So there's a lot of ways to make money in real estate and really in entrepreneurship. And you got to work with somebody that can help you keep more of what you make. We work really hard to change the lives of ourselves, our families, those around us, right? And you deserve to keep every penny you can, because nobody
Yep.
appreciates how much work it was other than you and other folks kind of in your circle that they kind of get it as well. And Michael
Yeah,
gets it too.
absolutely.
So Michael, thanks for
Yep.
sharing some insight. This is fantastic. I've been around for a long time and I learned some stuff today myself.
That's awesome. Yeah, awesome.
Yeah.
Thanks for having me, and love
Yeah.
to connect with the investors soon. So
Fantastic. Everybody, hope you got some great value from today's show. Check out Michael, go learn more, and hope to see you on the next show. Have a great day. See ya. Thanks for joining us for today's show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing on your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. You can also check out the show's notes for access to free resources, how to get access to world-class lead generation, and even how to work with me directly one-on-one. Don't forget to subscribe so you never miss another episode. See you on the next show.